All right. Okay, so I'll ask that you bring your conversations to a close so we can get going with more managerial accounting. You'll notice that this is a completely different set of topics than what you've seen in financial accounting. So, just do a lot of problems. Get accustomed to this new vocabulary. That's my advice to you. A few things. Top 2 questions this week on email in the discussion board. Where are the midterms? Again, that asked a lot. You'll see a big announcement just posted on the main page of WebCT. If you didn't pick up your midterm in class last week, I brought them all to the CUTV Student Center. So that is in D299 Loeb. So if you're in here, get out of Theatre B, turn left, go toward Loeb. Turn left again whenever you get to the brick wall that will be in your way. And you should see signs for D299 Loeb. Right? So just, you have to pick them up during their business hours. So that's from 8:30, I believe, in the morning to 7 o'clock at night. And it's through the double set of doors. Okay, so just keep going. And that's where they are. And the marking key for the midterm has been posted. I've had that up for a while. So you can see where you got your marks and where you didn't get your marks. The other question I've been asked is about the final exam. Yes, it has been set to December the 15th. I believe that's a Wednesday at 2 p.m. So check all of your conflicts and overloads. Check your own schedule. You can go into Carleton Central now, and your final exam schedule should be there prepared for you, but check it anyway. All right? Make sure you do not have overloads or conflicts. Okay? I'm talking more to the first-year students, because if you're in second, third, and fourth, you know this already. Okay? I don't know the location just yet. That's another question I often get asked. That will be posted toward the end of November. So check that same exam schedule, all right, either on Carleton Central on the main page. There's links on the main page of carleton.ca to get the exact location. And all you're going to get is a building. You're not going to get a particular room number. All right, so check that out. I've also been asked, will the exam be cumulative? Will it include everything? Yes, it will include everything. Okay, so all the chapters, 1 through 15 inclusive, you're going to find on that final exam. However, I'm going to weight it a little bit differently. You're going to see about 60%, 65% or so of the marks coming from the managerial accounting topics. So that's chapters 10 through 15. Okay. So maybe about 60 to 65%, and most likely there'll be the long answer questions. Okay, although you might see some in the multiple choice. The financial accounting will account for the difference, 35 to 40%, most likely multiple choice questions. Okay, yes, I have more multiple choice questions. All right, and about equally, you'll find few on every chapter here, and the long answer questions, most likely you'll find 1 question per chapter, okay, in the long answer question section. So most likely multiple choice. Most of the coverage there on long answer questions. So what else? Bring a I have to say this again. It's multiple choice. Bring a pencil. I had at least 5 to 10 students not bring a pencil. Bring a calculator. Okay, non-programmable calculator, please. Okay, you cannot use your cell phone. Had a few of those too. All right. So and bring your ID, especially for the final exam. They're going to be sticklers about that. So that is the final exam. All right. Any questions on either midterm, final, quizzes? No? It's all going well. The quiz marks continue to be really good, really well done. Good for you guys. All right. Important to keep doing them. I still see the odd person not taking a quiz, and it's they're easy marks. They're easy to get. Please just attempt them. Put something in those boxes. Give yourself half an hour every week. Attempt it. Okay. Get some of those the marks for the quizzes. And each quiz will be weighted equally as well in the calculation of the 20% of your final grade. Okay. So try them all out, please. All right. So no other questions? No questions? All right. The silent group. All right. All right. Yeah, I like this chapter because it focuses not just on business decisions that have to be made, but the same sort of decisions that we have to make in real life. Okay, so we're looking at differential analysis reports. So that's a fancy word for a variety of managerial decisions, but actually we make those same decisions in real life. Okay, so it might be make versus buy, but I mean you can apply that to real life. should I make supper tonight or should I just phone for pizza? All right. So I could tell you last night, coming home at 5:30, and somebody had to be out the door for a dance class at 6:30. I did not want to make supper, so the kids took a poll. I made pizza, but I know that it's more expensive. I didn't make pizza. I bought pizza. I know it's more expensive to buy versus making my own supper, but you know, I had some non-financial factors to consider there, all right? So that's one of the managerial decisions that we're looking at, make versus buy, okay? Another one is accepting a special price, okay? Should you do some work for, you know, a price that's a little bit less than what you'd ordinarily accept, okay? And you can certainly apply that in your regular life. Should you accept that, you know, seasonal job? It's not exactly, you know, the best paying job. You really would like to make at least $12 an hour, but you're given a job for $10 an hour. Should you accept it? Well, you know, if you're not doing anything else, you have the capacity. We're going to look at these issues. You know, do you have the capacity? Well, okay, I'll accept that job, or maybe no, I won't. I don't have the capacity. Okay. What's another one? Process further. I don't know if we can apply that to our real world sort of situations. And dropping a segment. Should I continue to do something that's not so profitable? Okay. So that's what we mean when we're looking here at managerial decisions. There's a few managerial decisions I'm not going to cover, okay, that are in this chapter. All right. So what am I not covering? I'm not going to cover replace equipment because I actually cover that in chapter 15 a lot better. Okay. I don't know why they even put it into this chapter, but replacing equipment we'll cover later. And lease versus sell. I just couldn't see why you would ever even want to look at that decision. I've never seen it covered in a textbook, and I've never even come across it in real-world accounting. So I'm not going to be covering those two managerial decisions. I'm just going to focus on 4. Okay, so instead of the 6, we'll look at 4. And then we'll look at determine the selling price. Okay, but actually we're just going to look at 1, the total cost concept. Okay, we're not going to be looking at product cost or variable cost. So I'm starting to pare down the chapters a little bit. So this is one that certainly won't take us as long to cover as what you might have thought. Okay. All right. So what does differential analysis mean? It means let's focus on the differences. That's simply it. Okay. We're going to focus on the difference in revenue, difference in expense. Okay. And that is it. And that tends to be what's relevant. Okay. So if you're faced with 2 decisions. I could do this, you know, your 2 options. You have to decide between doing this and doing that. Okay, I've got 2 options. Which one am I going to do? Which one should I accept? Focus in on the differences because those are what is relevant. Okay, and that is actually a definition of a relevant cost. Okay, is those revenue and cost items that differ between the alternatives. Okay, and we're going to ignore something called sunk costs. Okay, which means you paid for some piece of equipment in the past, and you know, you still have it on your books, and you're thinking, well, geez, I'd like to continue to use that piece of equipment, or you know, I've paid so much for that, you know, software or whatnot that you have, and a lot of people tend to think that that is still as relevant, but it's not. You've already paid for it. It's not going to differ between the alternatives. Okay, so it is no longer relevant. So let's just now just focus on what is a relevant cost. Okay? And so I've alluded to the fact that it's this differential revenue, this differential cost, okay? This difference between one alternative and another, and that is the very definition of a relevant cost. Okay? So you are faced with, at the beginning of the school year, a decision where you had to take a look at relevant costs. Okay? So you're coming to school, you're coming to Carleton, and some of you don't live on campus. Right? So how many people here do not live on campus? I know it's going to be at least half. Yeah, exactly. So you've got a decision. Okay, so some of you might live close enough you can walk. All right, so, or you can skateboard. I used to last term for 2 terms in a row. I had somebody skateboard to school every day. Okay, and that he'd managed to do that throughout the winter, and that's fine. Some people take their bikes year-round, and that's fine, but that's never going to be me. So for those of you who do not live on campus, the 2 decisions you've got to make about how to get here are taking the big red limousine here, okay, the OC Transpo bus, slash O-Train, okay, because I realize some of you are taking the O-Train, so public transit, okay, or driving here, all right? So how many people actually had that decision to make? You're going to take the bus, you're going to drive your car, your parents' car, grandma's car. Okay, so, all right, so this is relevant to what a lot of you had to consider. So let's take a look at that. Let's take a look at the relevant costs to take the bus. Bus, train. Okay. So what cost differed between the train and the car? Okay. But only pertained here to the bus. So what's one of your costs? One of the relevant costs of taking the bus in this decision? Bus fare. Okay. And that can be in a few different ways. Some of you might pay for tickets as you go, depending on how many times you come to campus, all right? Or it might mean a bus pass. Okay. How many of you would have gotten the bus pass anyway? Didn't matter if you were going to. Yeah. So most likely you'd have gotten it anyway. If you weren't coming to Carleton, would you have bought it, the pass? Oh yeah, that UPass thing now. Oh, so this is becoming, yeah, I heard of it, but it's mandatory?
Sure. Only if you live within the OC Transpo area. Yeah. And a full-time student.
How would they know? So you have to live within the city of Ottawa. Your address. So if you live within the city of Ottawa, okay, and you come to Carleton, you have to pay an extra fee? Is that how this works?
Yes.
But if you don't live,
Then you not.
okay. Well, let's pretend UPass didn't ever happen. Because that's not going to make for a good discussion here. Okay. You've got two options, and buy your tickets or buy your bus pass. I didn't know it was for sure, like you had to, and you could only opt out. I'd heard of it. All right. So let's say you were going to a university where there was no UPass. You would have to buy tickets or your bus pass. Okay. What other costs would there be to actually taking the bus? Besides that, that's the obvious one, but there's actually another one that isn't so obvious. Time, yes. It generally does. Yeah, yeah. To come to Carleton anyway, because I'm sure a lot of you aren't on a direct bus from your house to here. Okay, you're not on the number 4 or the one. Is it 16? Whatever it is. Is it 116? What other bus comes here? You're not on that line. So you have to transfer. Okay. You have to sit at Herdman. Okay. Or Billings Bridge or somewhere to get onto the 4 to get onto the 116. Is it 116 or 118? So 100 and something. Something teen, all right? And what could you be doing instead of waiting at the Herdman station? Making money? Yes. Yeah, so, you know, some of you could have accepted another shift, worked a little bit later at your part-time job, okay? So we call that an opportunity cost. Right, so by and large, yes, it is more time. You could have been doing something else with your time, and we call that an opportunity cost. You could have been making money. Okay? Even then, there's these non-financial things. So relevant costs to take the bus fare, your tickets, your bus pass. You could have been making money, or you could have been doing just about anything else. Okay? You could have been studying or whatnot. We just, you know, there's like the qualitative factors you also have to consider. Okay. Last time I did this lecture, somebody else brought up another relevant cost that they felt they had to incur in order to take the bus, and that was the cost of hand sanitizer, which I thought was kind of cute. All right, so if you're going to be in a public place, they were a bit concerned about germs and, you know, touching things on the bus. Yeah, they wanted to include the cost of hand sanitizer. Anyways, that's cute. Okay, so you could have also taken your car, your parents' car, grandma's car, whatever. The relevant costs going to be incurred there that you wouldn't have ordinarily have incurred? Yes. Yes. And gosh, it's getting expensive, eh? Is it all the gas in your tank or just the extra gas to come to campus? Yeah, yeah. Yeah, so extra gas to get to Carleton U. Okay. What else are you going to incur? You wouldn't otherwise. No, are you going to insure your car anyway?
We gotta pay for it. We gotta help insurance.
Yeah, you can't get a car plated without insurance, right? In Ontario anyway. I'm not quite sure about other provinces. Actually, the province of Quebec too. I used to live there. So you're going to incur that cost anyway. Okay, so therefore, it's not a relevant cost to drive in. Okay, the relevant cost, remember, is one that differs between alternatives. Okay, so I could take the bus. Do I have to pay for insurance? Yeah. I could take the car. Do I have to pay for insurance? Yes. Okay, so because it's a cost you're going to incur with both alternatives, it's not actually a relevant cost to drive to Carleton. John? Yes. All right, so some of you might have done the annual thing or the term thing, or you could do like me, I pay $12 a day. And I park in a longer term lot. Not all the lots have, some have 4-hour restrictions anyway. That's how much I've got to pay. I'm not quite sure what it is per month or whatever, but yeah, it is an increased cost, certainly. And it's one that you wouldn't incur had you taken the bus. Okay, and that's what makes it relevant. Any other costs of taking the car to school? Upkeep? So like maintenance costs. Okay. So we have to think of only the maintenance costs that you're going to now incur, the extra maintenance costs that you're going to incur by the fact that you're taking the car instead of the bus. So the things that wear out. What wears out on a car? Yeah. They generally go by mileage, right? So the more miles you put on, the more times you come to Carleton, the quicker you're going to have to replace them. Anything else? What wears out on a car? Does anybody drive here? Brakes, yes. Brake pads generally have a finite life. That's my husband. Anything else? Yes. Yeah. So, actually, I just bought a newer car. Actually, I bought a new car. I haven't bought a new car in about 15 years. And I've always had these old used ones. And now I only have to change the oil 12,500 kilometers as opposed to 5,000. I was stunned. So I'm going to incur a little bit less oil changes and oil filters and that sort of thing. Okay. So tires, brakes, oil changes, all these things that wear out. I think you've captured a fair number of them. All right. So and you can allocate this on a per kilometer basis. Tires are good for so many kilometers, brakes are good for so many kilometers, oil changes for so many kilometers, and actually come up with a cost of what it will add up to come to Carleton so many times a week, so many weeks a year, okay, and come up with that. Any other relevant costs to drive? Insurance, the gas. We've got the insurance isn't right. We've got the gas, the parking, the maintenance. What about your plate costs? Put a plate on it. They charge you. The Ministry of Transportation will charge you. Is that relevant? No, you have to plate it. Yeah, you're going to have to put a plate on it anyway. Okay. What about the cost of the car itself? Is that relevant? Are you going to have a car anyway? Your lease cost? Right? So if you were just buying a car or leasing a car to come to Carleton, then yes, I would put that down here. Okay, lease cost. But most likely, you're using your car for other purposes, not just to come to Carleton. So you're going to incur that lease cost anyway. You're going to have to pay that monthly payment, interest, principal. Okay, so that's not relevant. I mean, think of it. Relevant cost is one that differs between the alternatives. Would you have the lease payment if you took the bus? Is it going to go away? So yes, you would incur it by taking the bus. You'd incur it if you took the car. Okay, so it becomes not relevant for most of you. I doubt that any one of us would buy or lease a car just to get to Carleton. Okay. That's the only situation where that cost would be relevant here. Okay. Right. What other costs do we have with cars? Gas, parking, our license. Are we going to have a license anyway? Most likely. Okay. Although I have noticed a new trend. My daughter just got her G2, and none of her friends have got a driver's license. Why is that? Does anybody not have their driver's license here? No? So just what, eh? Two people. All right. And I thought whenever I was teenager, everybody was like chomping at the bit, wanted to get their license at the age of 16. Okay, wanted to drive. So I found that more an unusual sort of occurrence. None of her friends, you know, in a circle of 10 or 20 kids, nobody's got her license but my daughter. Anyway, so we've defined relevant costs. We see examples here of relevant costs. They have to differ between the alternatives, okay, in order to be relevant. All right, so avoidable costs. Okay, so if I take the bus, I'll avoid the extra gas. If I take the bus, I'll avoid the parking costs. If I take the bus, I'll avoid all these extra maintenance costs. Okay, so that's what makes that relevant. If I take the bus, or if I drive, I won't pay for tickets. If I drive, I won't have that extra time to get to Carleton. Okay, and so we call those avoidable costs. They are relevant. And we also talked about opportunity costs. Okay, so we could have done something else. So here we're just looking at it from an accounting point of view, but there is also the qualitative, and that's going to come into play into the decisions that we'll see here today. Okay, so some people might prefer to take the bus. Okay, they don't like to drive on the Queensway. They don't like to drive in bad weather. Okay, and we can't quantify them. We call these qualitative, non-financial factors. Right? So if you're one of those people, yeah, you prefer to take the bus. Okay, you'd prefer not to drive in a snowstorm or freezing rain. Okay, you know. Then do it. Right? Some of you prefer to drive. You'd rather not be on the bus. Okay? You'd rather not be, you know, on the 95, squished in like sardines, you know, standing up. Okay? You just don't consider that a very fun way to get to Carleton. You'd rather be in the comfort of a car. Okay? Well then, you know, that's something you have to acknowledge as well. Okay? So we have relevant costs. Also have the qualitative factors to consider. What is not relevant here? Costs that we've incurred already. Okay. That one's hard to understand, actually. Sunk costs. Okay. So costs have been incurred, it can't be avoided. So I'm just going to talk very briefly about one decision that I've seen in the past. A number of years ago, we were contemplating replacing some software. Okay, it was customized software. I'm not even going to tell you what job. And the cost of the software originally, if you can believe it, was $100,000, a whole lot of money. And we were depreciating it, amortizing it over its useful life. Okay, we said, oh, probably good for 5 years before we have to do a major upgrade. Okay, so we were taking depreciation or amortization expense of $20,000 a year. But about 3 years into the cost, the software's life, okay, it was still on the books at $40,000. Okay, and we said, hey, why don't we replace that? Okay, there's this other great software that's out there. Cost us $500. Okay, and you know, we'll still have this other software. It's got some historical data. We'll still be using it. You know, we need it to run certain other reports. It's got some certain other functionality, but we'd like to replace it essentially with something else that doesn't cost so much. Okay? And a lot of people looked at that because we were a group of people looking at this decision, and they said, you can't possibly replace that software. It's still on the books at $40,000. We paid $100,000 for it. What are you talking about replacing it with a $500 package? And I was the one advocating for the new $500 package. I said, but this is so much easier to use, and it's got different functionality. It's, you know, I like the new reports that come out of it. It can do so much more for us. Okay? I don't care that we paid $100,000 for it. It's not working to what we want it to do. Okay? There were some real issues with that. Okay? But a lot of people couldn't get over that. Okay? Oh, but we paid so much for it. Okay? Shouldn't we take it to the end of its useful life? Shouldn't we wait until we've written it off completely? And so the decision, if you take a look at it, okay, would we still continue to amortize if we replaced it? Yes. Would we still continue to amortize if we kept the software? Yes. So yeah, you're going to continue to amortize the software, because we were using little bits and pieces of it, for the next 2 years, okay, in both scenarios, keeping it or replacing it. So it wasn't relevant in that way. Right? A lot of people can't get over that. Right? But no, it's truly not relevant because you're going to have to amortize it regardless. Okay? There's still 2 more years left of amortization. It's still going to do that. Right? So that's why sunk costs are not relevant. And don't put them into any analysis. All right? So we're going to look at 4 situations, not 6. Okay, so as I alluded to earlier at the beginning of the lecture, I will not be covering lease versus sell, and I will not be covering replace equipment because that's going to come up in our capital budgeting chapter in chapter 15. So we're going to look at 4 situations here. Discontinuing an unprofitable segment. Okay? Or it could even be a segment that's not giving you as much profit as you'd like it to have. Okay? So, you know, and this is what's faced by companies all the time. So I was at one of my jobs yesterday, and they've got a subscription to Report on Business. So I was reading it at lunch, and I inevitably always find something like this, where there's a company that's thinking of selling an unprofitable segment, or a segment that's really not what they'd like it to be, okay, not as profitable as they want. So there's Danone. They're a group in, I think it's in Europe, they're based in Europe. They're going to be selling off their water unit, their Evian label, okay, to a Japanese firm. All right, so they're considering that. So Japanese suitors are circling Group Danone SA's sprawling bottled water business, which includes the Evian brand, people familiar with the matter said. Representatives for Danone and Japanese beverage companies, including Kirin Holdings Co., are holding early-stage discussions over a possible deal, people said. Other possible suitors for the part or all of the business, which would fetch between 5 and 7 billion if sold in its entirety, include Suntory Holdings and Asahi Breweries. Representatives for the Japanese companies declined to comment. Okay. Anyway, so they're looking for the best offer. They're shopping it around. And it just says here that, continues on. Just go straight here. The exploration highlights the hard times that have befallen bottled water in recent years, especially in developed markets. After a decade of rapid expansion, growth in demand sputtered with the onset of the financial crisis, as many consumers suddenly saw bottled water as an unnecessary luxury. Concerns about the environmental effects of plastic consumption and the energy used in bottling water compounded the matter. Danone's water business, which also includes such brands as Aqua and Volvic, is the world's largest by volume. So it was the slowest growing, I don't know if you can read that, slowest growing of Danone's 4 business lines with comparable sales. Okay, so they've segmented all of their businesses. Bottled water is one of them, and they're saying, it's not growing as fast as we like. It might actually be losing money, but they're not going to come out and say that. They're negotiations. But they want to sell it, to drop it. Okay? And so that's an example of discontinuing an unprofitable segment. Okay? It happens all the time. You see bits and pieces of one company being sold to another company. Right? So that decision, should we drop it? Should we keep it? Right? And that's a really hard decision for Danone. Okay? They might continue trying to market bottled water in different ways so that they can capture more market share, or they might look at different geographic areas, but how long do they continue to do that till they just give up and say, okay, time and enough, losing money, okay, let's sell the farm. All right, another decision we're going to look at, manufacturing or purchasing a needed part. You don't see as much newspaper coverage on this, but I can tell you it's something I see almost daily, okay, at the various jobs that I have. Okay, should we photocopy something? Because we've got these really fancy photocopiers these days. Or should we send it to the printers? Okay, so that's the sort of decision that I see time and time, especially recently. Okay, or should we hire somebody new, or do we just use our existing staff to do this new function? Right, so make or buy, manufacturing or purchasing a needed part. It also service too. Right. So see that many times. Another decision, processing further or selling an intermediate product. Okay. This is especially true in companies where you've got a natural resource. You can refine, you can extract out of the ground, or you can refine further. Right. So we're going to take a look at that. You can cut down a tree. Right. You can sell the raw logs, or you can chip it, send it to a paper mill. Or accepting additional business at a special price. Normally charge, $12 for each of the units that you make. But somebody says, how about I give you $10? Did you accept it? I don't know. We'll take a look. All right. So, first situation that we're faced with here, discontinuing a segment or a product. So what am I talking about? Segments can be anything. Okay? It can be based upon product lines, so as they've alluded to here. Okay. It could be, selling the water division of Group Danone. Okay. But segment can be, like I say, anything. So yeah, product, and I also mean to say their service. Okay. It could be a certain geographic location as well. We can segment in so many different ways. Should we continue to have operations in Canada, okay? Or should we just sell to the States? It's another segment. Who your customers are, you know. So should we continue to sell to government, or should we just sell to, you know, private companies or something like that? It's up to your imagination as to how you'd like to segment it. And oftentimes we get income statements based on that segment. Okay. So here we have a company, you know, faced with that exact decision. Battle Creek Cereal Company produces and sells 3 kinds of cereal. Bran Flakes exhibits an operating loss. Oh no. There it is. Losing $11,000. Okay. So the company is considering discontinuing production and sale of the product. Okay. Actually, this is one of the decisions as well that's facing, I have other part-time jobs. Right now I'm 3 others, but anyway, I digress. And one of the companies I'm working for, they're considering this exact thing. They've got different product lines. Okay. So, and they're looking at restructuring, doing all sorts of things. One of the product lines is very, very profitable. It's scientific journals, actually. Okay. And then we've got another, it's a service line. It's membership services. Okay. This one's making money. This one's not making money. And so it makes sense, yes, we're going to keep the journals, but, you know, should we continue to offer membership services? Right? Should journals continue to offset the losses in membership services? Okay. Is this part of the larger mandate of the nonprofit that I'm working for? It's really a difficult decision. Okay. It's oftentimes, you know, sales in one affect sales in another. So if we drop membership services, we might lose some of the subscription revenue in the journals. Right. So this is what's happened here to Battle Creek Company. So they make 3 different kinds of cereal: corn flakes, toasted oats, bran flakes. Bran flakes looks like it's losing money. Okay, so let's pretend we're a manager. Okay. And the 2 decisions that we've got is we can keep the bran flakes. All right. There's our first thing that we can consider. This first option: keep it or drop it. Okay, so 2 options. Imagine you're Victor Newman of Young and the Restless. Okay, so he's faced with a business decision. Should I keep that division? Should I drop it? Okay, so what he's going to do is he wants to take a look at what does his income statement look like if he keeps it, and what does his income statement look like if he drops it. Right. So we've got this information on the bran flakes. Let's do exactly that. So if I keep it, what will my income statement look like? Well, we'll start with sales. If I keep it, well, I'm going to just pull that number from that financial statement that says I've got, you know, $1 million in sales. And so if I keep it, my income statement will look exactly like that last column. I've got cost of goods sold, variable and fixed. Is it 220? And I've got operating costs, variable and fixed. So I'm just transposing those numbers. What do we get? 69,000. Okay. So that's my net income if I keep the bran flakes. Okay, it'll look exactly like this column here. Okay, my total company column. Now if I drop it, I know my sales are going to be a little bit less, right? So instead of being $1 million, I'm going to subtract the 100,000 there. I'll only have sales of 900,000. Okay. The next line is the cost of goods sold for variable costs. Will I incur that if I don't make the bran flakes? No, I won't. Okay, by definition, okay, go back to chapter 2. Variable costs are only incurred if you make the product, right? So the variable costs, what were they? In terms of cost of goods sold, direct material, direct labor, variable overhead. Okay. If I don't make bran flakes, I'm not going to incur the direct materials to make the bran flakes, the bran. Okay. Therefore, I'm not going to have that cost here. I'm going to subtract it out. What is it? 480 minus 60. I'll keep these all in memory. This will be 420,000. Okay. Just by definition, if I don't make bran flakes, I will not incur the variable costs related to bran flakes. What about my fixed cost of goods sold? The next line. I've got 20,000 there just for bran flakes. Okay. So in total, 220,000. Will I incur the $20,000 of fixed cost of goods sold for bran flakes? Most likely, yes. Yeah. So consider what this is. Fixed cost of goods sold. That's most likely fixed overhead. Okay. And what is fixed overhead? An example of fixed overhead. We've done this in a previous chapter. Give me an example of a fixed overhead item. Yeah, the fixed factory costs, property taxes, insurance premiums, janitorial salaries, supervisor salaries. Okay. Will I still have to pay the property taxes on my factory? Yeah. You can't just go knocking on the door of the city and say, well, you know, I'm not making bran flakes anymore. Can you reduce my property taxes? They're not going to go for that. Well, you still have to pay an insurance premium on your factory building. Yeah, you know, unless you're asking for different coverage amounts, most likely your premium will stay the same. Okay. So by and large, a lot of these fixed costs we're just allocating to bran flakes. Okay. And we're still going to incur even if we drop it. All right. So I'm going to put in 220 there. Okay. Variable operating costs, that's the next line that I've got there. So bran flakes, variable operating cost of $25,000. Okay, so you know, some variable selling and admin, right? Or what would that be? Commissions, okay? So maybe some shipping, okay? By definition, variable costs, I'm not going to incur that $25,000 of variable operating costs if I don't make bran flakes. So I'm going to subtract it out there. Okay. Fixed operating costs, well, I still have to pay for the accountant's salary if I drop bran flakes. Yeah, please pay the accountants. Okay. So these costs are going to continue regardless. Okay, so what does that mean to my bottom line? Wow, if I kept bran flakes, I'd have $69,000 in net income. If I drop it, it goes down by $54,000? How can that be? It's these fixed costs, okay? The fixed cost of goods sold, your fixed operating costs, you're going to continue to incur it, okay, regardless, keep or drop, right? And that's why your net income is going to go down if you drop it. Doesn't look right that way. We're looking at this income statement and it's saying, oh, we're going to lose money, you know, by continuing to make bran flakes. But you have to be aware of these allocated fixed costs. Okay, they're going to be incurred anyway. Okay, so we've talked about this. What are the relevant costs? So you need to know how fixed costs would behave. Okay, and we've talked about that. You know, will the fixed costs be saved if the bran flakes are dropped? We've gone through that. By and large, fixed costs will continue to be incurred. Okay. So what the book does is it just focuses in on the differences. Okay. So they say, what are the differences in revenue if you drop bran flakes? Well, you're going to lose $100,000. Okay. What are the differences in costs going to be? Well, just the variable cost of goods sold, variable operating expenses. So they're coming up with, let me move this out of the way, annual differential income from the sales of bran flakes of $15,000. We got that. The difference between these two is $15,000. Okay. We just took the long way around. Okay. And you can do that. You're going to get to the same conclusion with the same numbers. So, had we kept bran flakes, net income would be $69,000. Dropping is $54,000. That is a difference of $15,000. Our net income will go down. That's exactly what's been highlighted here. So what else should they consider? Because it's not just about the money. Right? They drop bran flakes. Yeah, exactly. And they might not buy the other product lines. Well, so you might get some effect on your other cereals here. Where are we? Your toasted oats and your cornflakes. Okay? It might be part of a larger product line, okay, that would be adversely affected, certainly. All right. Remember, one of the variable costs here, we're not going to be having variable costs, and certainly in variable cost of goods sold, one of the key items there, direct labor. Okay? So that would mean that you're going to be laying off some people who work on the assembly line. Okay? So consider that in your decision as well. Is that something you'd like to do? Right? Is there other places that these people could work? Right? Right. What else should we consider? So his point is that you might have long-term contracts to buy your raw materials, your bran, okay? And so you might be in a long-term contract, or we're going to buy 100,000 tons of bran, and now you're going to cut that. What about the potential for lawsuits? That's a great point, okay? Or maybe that supplier you're also dealing with, they give you the oats for the toasted oats and other product lines, and there's going to be, difficulty in your relationship there, your business relationship, if you suddenly break that contract. All right, so we're going to do an example, condensed product line income statement for Suffolk Chinaware Company for the month of December is as follows. So they make bowls, plates, and cups. So oftentimes, yes, we do like to keep our income statement by product. Okay, and we've got sales, cost of goods sold, profits, selling and admin. So very similar to what we saw with our cereals. What do we have to do here? I'm just looking at this income statement, and cups seem to be losing money. Right. So we need to know what's fixed and what's variable. So they're telling me fixed costs are 15% of the cost of goods sold and 40% of the selling and admin. Suffolk Chinaware assumes that fixed costs would not be materially affected if the cups line were discontinued. Okay, and that's important because sometimes there might be a fixed cost that you actually would drop. Okay, and they're saying no, this is not the effect. So prepare a differential analysis report for all three products for December 2010. What is that? Differential analysis report. So I'm going to go back because I do have a differential analysis report. There it is. This is a differential analysis report. Okay, so we're going to set it up like that. So what do I want to know? Differential revenue. And I think they wanted it by product line, for all three products. So I'm going to need to have a column for bowls, plates, and cups. Okay. And so, what else? So revenue from sales. And then we're going to look at differential costs of each of the products. And variable operating, which I think is the same way that it's set up here. Variable selling and admin. Okay, they want to call it variable selling and admin. Okay. That's the way I'd like to divide it up. Okay, so the differential revenue, that's pretty straightforward. That is the sales of each of the product line. Okay, so simply going to put in revenue from sales. Is it 54,000 for bowls, 68,500 for plates, 24,500 for cups. Okay. So my template, the one I borrowed from the previous slide, said I should only be looking at the variable costs. Those are the only ones that are relevant. Those are the only ones that we're not going to incur if we drop bowls and if we drop plates. Okay? We know that fixed costs will continue. So I need to find variable cost of goods sold. Of course, I see cost of goods sold, but it doesn't tell me what the variable portion is. I think I'm going to need to calculate this, right? Because it told me what fixed costs are. Fixed costs are 15% of cost of goods sold. So I guess that would mean variable cost of goods sold is 85%. Okay. So that seems to apply to all of the product lines. So if I take the 22,400, multiply this whole line by the 85%, because if it's not fixed, it's variable. Right? If it's not variable, it's fixed. They're telling me what is fixed. Fixed cost, 15% of cost of goods sold. Therefore, the variable portion, 85%. So I'm going to multiply each one of those numbers. So for bowls, 22,400 times the 85. At 19,040. Plates, 31,700 times 85%, 26,945. Cups, 11,900 times the 85%, 10,115. Okay. All right, we got that line. Next, we need variable selling and admin. Again, we're given total selling and admin. We need to pick out the portion that's variable. They've told me that 40% of the selling and admin are fixed. Well, if it's not fixed, it must be variable. So the remainder, 60%, would be variable. So I'm going to take that whole line, each individual amount, and multiply it by 60%. That must be the variable portion. So 25,300 for plates. Multiply that by the 60% variable portion, you get 15,180. 20,400 for cups times 60%, 12,240. And this will give me just the true differential income. Because all of those fixed costs, the fixed cost of goods sold, fixed selling them in, you're going to incur that anyway. That's what they're telling us. Okay. So at the end of the day, it looks like each of the product lines are truly profitable. Okay. We've got bowls giving us differential income of 51,940, plates profitable, plus 26,375, and so are cups, amazingly, $2,145. So although looking at this income statement that's provided in the problem, you think, well, maybe we should drop cups. A lot of the costs that we're allocating here to cups would continue. The fixed costs would continue, even if you drop the cups. Okay, and that is really difficult. It's what we're doing right now with one of the nonprofits I'm working at. Yes, the journals are profitable. Doesn't look like membership services are profitable, but you know what? A lot of those fixed costs are going to continue anyway. Alex?
Your annual differential income should be a lot lower than 15,000.
Is my calculator not working? You're right. My calculator is not working. Minus 19. Thank you. I'm glad somebody's calculator is works working. So I'm getting now 17,980. Is that what, anybody else have a calculator that works? Is that what it should be? I'm going to blame my calculator because it couldn't have possibly been me. Yeah, that looks good. 17,980. All right. So yeah, that's the sort of decision that we're facing at one of the nonprofits. Should we drop something? Doesn't look profitable, but I know that if we did drop membership services, a lot of those fixed costs would continue. They've got a lease. They're going to have to continue to pay rent. Okay? And leases aren't easy to break. Right? We've got other fixed costs. We have to pay for the telephones coming into the building. Okay? And that doesn't matter if we don't offer membership services. We'll still have to have 2 phone lines or 3 phone lines coming into the building. So beware of allocated fixed costs. That's the motto here.
Offset that loss as a company. If you're looking at through the commercial board, and if you're looking at the saving, you're losing money, but you should drop it because you're not. So what would you do with that? What would you do to lower your expenses on the cost side?
Yeah, that's a good point. So, most people are going to look at that and they drop it, and then you're saying, no, but don't drop it because, it's truly profitable. So that's the question. What can you do here? My suggestion would be to remove the fixed costs from this product line income statement, okay, as we've done here, okay, and just show fixed costs as a separate line below here, okay. So we've got sales, we have our variable costs, total them all up, maybe in another column, and then show fixed costs, subtract it from that. This is a contribution margin, actually. Subtract it from the contribution margin. Don't allocate your fixed costs to each of bowls, plates, and cups, unless you can truly tie that fixed cost to each of the product line. Okay? If you've got a salary of a person who only works in the cups department, and if you didn't have cups, he wouldn't or she wouldn't have a job, because you'd save that amount of money, then yes, put that down as a fixed cost. But don't show reports where you're just allocating fixed costs like that, because they are misleading, at the end of the day, right? And so, at the nonprofit I'm working at, the senior management team gets this, the board of directors gets it, and they're thinking, oh, well, we're losing money. Well, no, we're showing you allocated fixed costs. Okay, maybe we shouldn't be. Okay, should the cups line be retained? Yes. All right, so we answered that. Okay. So, another decision often faced by businesses, and that you're not going to see in the newspaper, unfortunately, is make or buy. Okay, should we make this component part? Might not even be a component part. It might be a service. Okay, should we, have a consultant come in and do this work for us, write this report, or could somebody do it internally? Should we send something out to the printers, but we've got this fancy photocopier? We could do that internally. Should we design something in-house? We face that a lot with one of the nonprofits I'm with. Should we design this brochure, internally, because we do have some capacity there. We've got a person who's really skilled at that. Or should we send it out to a designer, okay, and pay top dollars for it, okay? And there's the dollar aspect to it, but there's also the non-financial aspect to it, which we will get to, okay? So let's just look at the numbers for now. Got a company here, they're an automotive company. They've been buying instrument panels for $240 per unit. Somebody's saying, hey, I think we can save, they're considering making the part. Maybe we should do this. But the cost of making the part, if we look at all of these component costs, $280. Okay? So direct labor, direct material, variable overhead, fixed overhead, $280. What should we do? We're operating at 80% of capacity. We could make the instrument panels. I don't know. Should we make or buy? Okay. So again, it becomes what costs and revenues here are relevant. Which ones are going to change, right, if I make the part? And which ones are going to change if I buy the part? Okay. So, it's kind of like a manager, looking at two sides of the decision. What are my relevant costs to make? What are my relevant costs to buy? Right. So, if they make the part, what's one of the relevant costs? Let's go back here. Which one of these costs is going to be incurred if they make the part and they don't buy it? Just by definition, what do you think? Variable costs. Okay, that's perfect. Which ones are my variable costs? Or direct materials variable costs? Yes. Or is direct labor a variable cost? Yes. We took this up in a previous chapter. Variable. Is variable overhead? Oh, I hope so. Is fixed overhead variable? No. It's got the word fixed in it. It is not variable. All right. So the relevant costs here in making the part, by definition, all the variable costs. So direct materials, actually I got the slide printed out. Where are you? $80. Direct labor, $80. Variable overhead, 52. Will I incur fixed overhead every time I make the instrument panel? No, I will not. Okay. So I get $212 there. Okay. What's the relevant cost to buy it? Well, we were told what the cost is from the outside supplier. So they've been buying the instrument panels, $240 a piece. Okay. So it seems, you know, at first blush, maybe we shouldn't make it, but now looking at what are the relevant costs for this decision, maybe we should make it. Okay. Because by definition, the only costs we're going to incur here if we make the instrument panels are the variable costs. Okay. Just by definition. And looking at that list of costs, the only ones that were variable were direct materials, direct labor, variable overhead. And so I always get asked, but no, the total cost per unit, if you include everything, is $280. Yes, we are including an amount there for fixed overhead. And let's go back to what fixed overhead is. What is the nature of fixed overhead? We had some examples from a previous lecture, okay, and even today. What is one of my fixed overhead costs in this factory? Rent. It's another. Let's say they pay, I don't know, $25,000 a year for that. It's another fixed overhead item. What is fixed overhead? Give me an example of a fixed overhead cost. Insurance. Great. Okay, so they pay $10,000 a year in insurance. Okay, let's just keep it that simple. These are expressed just as big total dollar figures. Okay? Are they incurred every time you make an instrument panel? No. Will your insurance premium go up if you make an instrument panel rather than buy it? No. Will your rent go up if you make the instrument panels? No. Okay. Hence the word fixed. Okay. It does not matter what you do in your factory. If you're very busy or not busy at all, if you're making instrument panels or buying it, these are fixed over wide ranges of activity. Okay. In order to get to this $68, okay, somebody has gone to the bother of allocating fixed overhead somehow by the number of instrument panels. Somehow they've done some allocation. And maybe it made sense to them. And they've gotten $68. Okay, they've taken a total fixed cost, which will not change over wide ranges of activity, and divided it by the number of instrument panels to get the $68. Okay. It is not incurred every time we make an instrument panel. Okay. Therefore, it's not relevant. Okay. Relevant costs only change, okay, if in this case we make versus buy. Okay, we decide to make. We will not incur more rent. We will not incur more insurance on our factory. Therefore, it is not relevant. Okay, this is why we're not including it. We're only including variable costs, because those are, by definition, the only ones that will be incurred if we make it. Okay, make the instrument panel. Okay. And that's why now it looks like a great deal to make instead of buy, because we've taken out the fixed overhead. That fixed overhead, that's going to continue. It doesn't matter what we do. make or buy, fixed overhead will be $35,000. Will not change. So there we go. We've got the proposal, the differential analysis report here, make or buy. It's exactly what we've identified in the previous slide. Okay. The purchase price, the relevant cost to make, the relevant cost to buy. So if we make it, we'll save $28 per instrument panel. Now, this only is applicable, though, if they've got the capacity to do it. Okay. If they don't have the capacity to do it, then they should not consider this. And it's not just about the money. Those were the numbers, and they're telling us one thing. They're saying, let's make the instrument panel. But what else should we consider? You're the manager. What else should you consider? The quality. Can we do a better job than our outside supplier? Maybe not. What else should we consider? You're the manager. You're the Victor Newman on Young and the Restless. You're faced with this business decision. It's not just about the dollars. It's about the non-financial things as well. So the quality, will we do a good job, as good as the outside supplier or not? What else? You worried about maybe the contract again? You know, maybe you have a contract to buy so many of these and you'd have to break it? Something to consider. What else? There's lots of things I'm thinking of. Yeah? No? Shall I pick on somebody? Right. Let's consider this. You're the manager. The numbers look great, but maybe the quality isn't there. All right, so quality is fine. What about that supplier? Okay, is that supplier going to be in business next year? Okay, what about the financial solvency of that supplier? Are they offering you a price, you know, of $240 this year, but you can't be guaranteed of next year's price? Maybe it's going to be $300. Okay. Maybe your own price of your own direct materials is going to go up. Okay, you're getting a bargain discount this year. Next year you can't be so certain. So you might want to reevaluate this. Okay. So yeah, your financial solvency of your supplier, price of your supplier's price, as well as your own input prices. Anything else that you can think of? Will they deliver on time? You need this instrument panel to make your car. Okay, it's an integral part of a car. You need an instrument panel. But if your supplier can't deliver on time, or if you can't keep up, if you're making it, you can't keep up with your own assembly line, then maybe you shouldn't be making it either. Okay? Think about delivery. It might cause a bottleneck, right, in your assembly line. Right. So we'll work on an exercise here. The Theatre Arts Guild of Chicago, the TAG-C, employs 5 people in its publications department. These people lay out pages for pamphlets, brochures, and other publications for the TAG-C productions. The pages are delivered to an outside company for printing. The company is considering an outside publication service for the layout work. The outside service is quoting a price of $15 per layout page. The budget for the publication department for 2010 is as follows. So somebody has costed out all of the salaries, benefits, supplies, office expenses. And they've allocated some of the office depreciation to this department and some computer depreciation. The department expects to lay out 20,000 pages for 2010. The computers used by the department have an estimated residual value of $7,000. The publication department office space would be used for future administrative needs if the department's function were purchased from the outside. So we're asked to prepare a differential analysis report dated December the 15th, 2009. So this is E127. Differential analysis report. Again, I'm going to go back to the slide. I actually had one. So we know what the template is. There it is. The differential analysis report. So this is our template. The relevant cost to buy it, the relevant cost to make it. Okay, so this is cost to buy. And what are we comparing it to? The differential cost to manufacture. This is the cost to make. Right, so we've got the format. We know what a differential analysis report looks like. Let's do it for the Publication Department of the Theatre Arts Guild of Chicago. So if they were to buy the layout work, the service for layout work, they're telling me it would cost $15 per layout page. Well, okay, obviously I'm going to have to multiply by the number of layout pages. Okay, so there's the outside price. How many layout pages did they have? It's not here. Here it is. The department expects to lay out 20,000 pages. Okay. Alright, let's hope my calculator can work. Yeah. Anyway, there are 3 zeros at the end. $300,000. Now let's look at the differential cost to manufacture, the cost to do the layout internally with this publication department. Okay. So the budget for the publication department, it looks like they're trying to get rid of the whole department. Okay. So, you know, what costs would be dropped if we did what costs would we incur if we made it? Okay, and it's an all or nothing thing. It's the entire department. Okay. So the entire department's salaries, are they relevant? Yes, exactly. And normally I'd say, yeah, just go to the variable costs, but consider what the decision is here. Well, we could buy that service, or we can do it internally. And by doing it internally, we incur all of these costs. And we only incur these costs if we do it internally. So salaries. What about benefits? We incur that if we make it internally. It's a whole department. Yeah. Supplies. Will they continue to incur supplies? Yeah. All right, so far, so good. Office expenses? Yeah, at 25. Now this is where it gets tricky. Office depreciation. Would we continue to depreciate the office building okay, if we went outside? Yeah, they actually told us what they do with the office. This office space, this office space that the publication department uses would be used for future administrative needs. They'll continue to depreciate it. Okay, so you know that is not a relevant cost here to make because it would be incurred both ways. If they made, if they buy, they're still going to take depreciation on that office space. Okay. So we're not going to include that. The computer, that's an X. Computer depreciation. I think they did mention that in the same area. The computer used by the department would have an estimated residual value of $7,000. We all remember what that is from a few chapters ago. Residual value, what we can sell it at today. Okay, so we could sell all of the computers for $7,000. So that does become relevant because you would, looks like they would sell the computers if they bought the service. Okay. So I'm going to add this to my differential analysis report. It's unfortunate I didn't make enough space here. The cost to buy, the purchase price. I'm going to add, let's do it in a different color so you can see it a bit better. If we bought this layout service, it would cost us $300,000, but at the same time, we're going to sell computers. So I'm going to subtract $7,000 here because we're getting a little bit of extra revenue from doing this. So the purchase price, the relevant cost to buy, are actually going to be defrayed a little bit. It's only going to cost us $293,000. Okay, so we're just continuing that bit of analysis there. So I think we've addressed all of the costs. So I just have to total this up. So the cost to make, oh, and here we go again, $310,000. Okay. Doesn't look right, eh? I put the dollar sign too close. Do it this way. 310,000. Okay, so that's the cost to make. Those costs will only be incurred if I make the do the service internally. Do the layout pages. Okay. The cost to buying that service is $300,000, but it's going to be offset by the amount I'm going to get by selling the computer. So it nets out to $293,000 for 2010. All right. On the basis of your analysis in Part A, should the page layout work be purchased from an outside company? What's cheaper? Buying it from the outside company. Okay. What additional considerations might factor into the decision? Not the numbers. It's not always about the numbers. You're going to let go of some staff, okay? And that's going to have an effect on the morale of the remaining staff. Okay? And it might reflect poorly on the reputation of this, what is it, Theatre Arts Guild of Chicago. Something else to take into consideration. Okay. Maybe this purchase price will go up in the future. Right? They've got you in at $15, but how do we know that next year it might not be $20, $25 a page? They might want to get your business so badly that they're bringing you in at a very bargain basement price. Okay? So you might want to look into getting a longer term contract to guarantee the $15. Okay. You might worry about the quality. That came up earlier. Yeah? No, because we're going to incur that anyway. If we make, if we buy, you'll still incur depreciation on that office space. Yeah, that's another way of looking at it. Yes, we would incur office depreciation here. Yes, we could add it here. We'll also incur it here. Okay, if we bought it, we'd still incur it because they're saying they're going to continue to have that space. So yes, you could conceivably add 30,000 here, add 30,000 there, and it's not going to make any difference to the difference actually. The difference between these two numbers, what is it, 17,000? There's a $17,000 advantage to buying. If we add $30,000 to each of them, because we're saying yes, we'll still incur them, you'll still have a difference of $17,000. But I'd rather just focus in here on what would actually, what's relevant. The costs that would only be incurred if we made it. Yes, we'd incur it in both ways, but the only costs we incur are these. So I think we've covered what other considerations, additional considerations might factor into this. Okay. And the office expense, yes, that's in there. Yeah, we put the office expense in there. We've got that. All right. Any questions on make versus buy? All right. So, let me go back here. Like I mentioned earlier, a good example of this even at home is, should I make supper tonight or just, order pizza? If my kids had their way, I'd order pizza every night. But anyway. But I know that that's more expensive than my relevant cost to make it. Okay. So my relevant cost to make a meal for my family, between $5 and $10 a meal. I've actually calculated this before. What did pizza cost me last night for the 5 of us? $29.90. Right? So I know that it's more expensive. However, the qualitative factors that you've got to take into consideration here, convenience. I didn't have the time to make supper. Right? So they always come into effect. What additional considerations might factor into the decision? All right. Next decision we might be faced with in the business. Should I sell my good or my service as is now, or should I continue to process it? Okay. So I've got an example here. Actually, I pulled it directly from the textbook. A company that extracts oil out of the ground. Okay, oil, as some of you may know, has got many uses. You can do a lot with oil. We see it in plastics. We don't just see it in gasoline. See it in heating products. Obviously, they're telling us here, you can turn it into kerosene. Okay, we use it oil in our car. We use it in paint. Actually, we put it into vinyls. You know, we see oil in a lot of different things. So we can further refine crude oil into many different things. Okay? So they've made it rather simple here. They're saying a 4,000-gallon batch of kerosene sells at $2.50 per gallon. Okay, so kerosene is this one in the middle. Okay, so there's my kerosene. I can sell that at $2.50 per gallon. Okay, and that comes from 4,000 gallons of oil costing 60 cents per gallon. Okay, so there's my raw material. And you can see this distillation and whatever they do. I'm not a chemical engineer, but maybe somebody here is. But I know that it's quite the chemical process to get oil into kerosene. Okay, and so that's why they've got these funny little flasks and whatnot, and one is becoming the other. So oil becomes kerosene. Alternatively, you can keep processing, you know, your kerosene and turn it into gas. So here's, if we keep going, this can become gas. Right? So one product becomes another, even. But if we make gas, we can sell it at $3.50 a gallon. So wow, that's a big profit. Okay? At the kerosene stage, I can sell it at $2.50. If I decided to make some gas, I can sell it at $3.50 a gallon. So, you know, sounds a little bit more profitable. Maybe I should do this. However, 20% of the gallons of kerosene will evaporate during the production. Okay. All right. So what should I do? Well, what costs and revenues will change? Again, we're looking at this differential analysis. Okay. Well, we will get extra revenue, okay, if we process further from kerosene to gas. Okay. So it's what is the difference? Instead of selling at $2.50, I can sell it at $3.50. Great. So looks like, you know, an extra $1. I will lose some in the evaporation. All right, I know that. So you lose some of the volume due to evaporation, but I've also got some extra costs to refine further. Okay. And so those are the only items here that are relevant, those things that will change. Okay, so our revenue items will change, our cost items will change. There is a cost to processing further. So here's my differential analysis report. All right, so, you know, for a lot of this, it's going to be a matter of just memorizing the format of it. Okay, but I can tell you that your See Now quiz will help you with this. It'll show it a little bit, and we'll get to that later. So the differential revenue from further processing. Okay. Well, I can take that 4,000 gallons. I'm going to lose a little bit due to evaporation. They told me 20% would be evaporated, so 800 gallons gone. So I'm going to be left with 3,200 gallons. Okay, and I'll get $3.50 per gallon. Great. That's $11,200. I could have sold it as kerosene. Okay. And I would have only made, in that case, $10,000, right? 4,000 gallons times $2.50. So my differential revenue, the extra revenue I'm going to get, because I'm taking my kerosene, I'm distilling, and I'm doing all sorts of things so that I get my gasoline, I'm going to get an extra $1,200. But I have to compare that to my additional costs of refining further. Okay? So $650 they're telling us. So is it worth refining into gasoline? Looks like it is. At the end of the day, I get an extra $550. Okay. What is not relevant here is the sunk cost. The 4,000 gallons of oil costing 60 cents per gallon. Okay, I'm incurring that. Doesn't matter if I stop at kerosene or if I refine further to gasoline. Okay, I will have paid 60 cents per gallon for my oil. Okay. So that is not relevant. That's actually what they call a sunk cost. You've already incurred it. You know, you're trying to decide, do I sell it kerosene or do I sell it as gasoline? So there we go. So the differential revenue and cost to produce the batch further will be the focus. The initial raw material cost incurred in both alternatives and is not considered. All right, so we've got an example. Oh, it has to do with coffee. Oh. It's almost time, eh, for a coffee break. We'll do this example and then we'll have a coffee break. Seattle Roast Coffee Company produces Colombian coffee in batches of 8,000 pounds. That's a huge amount of coffee. Think about that. 8,000 pounds, their batch, in one batch. Anyway, the standard quantity of materials required in the process is 8,000 pounds, which cost $5 per pound. Colombian coffee can be sold without further processing for $10.80 per pound. Colombian coffee can also be processed further to yield decaf Colombian, which can be sold for more, $12.50. Okay, so you know, it only stands to reason if you're going to be further processing the beans, you should command a bigger price. And they're telling me if you process it further, you can get $12.50 a pound. All right. The processing into decaf Colombian requires additional processing costs of $10,500 per batch. The additional processing will also cause a 5% loss of product due to evaporation. So again, very similar to the kerosene turning into gasoline. It's evaporating. What do we have to do? Prepare a differential analysis report. Oh, here we go again. 11. Okay, so we've got this decision, prepare this report. What is this report? The template is given here. Okay, this is your differential analysis report. What is the extra revenue compared to the extra costs that you're going to have of processing further? Okay, so first up, differential revenue from further processing. Just borrowing the template. So I'm going to ask you, you're going to have to memorize this part in order to do well on the quiz and the exam. All right, so what is included here in the calculation? What's the revenue from the sale, in this case of decaf? And we're going to compare that to the revenue from the regular Colombian. Right. And then at the bottom, we're going to be looking at differential cost of further processing. Okay. That's all that this template is telling me. What's the difference in revenue, difference in costs? All right. So what is the extra revenue from decaf? If you were to calculate it, what numbers would I need in the calculation here? What do you think? A lot of numbers in the problem. But what's the revenue we're going to get from selling decaf? Can they tell me? We're going to look at it from the perspective of one batch, let's say. Yeah. Okay, so that's actually a good place to start, is how much is this batch? Well, we know that
7,600.
7,600, very good. Okay, so what Alex has done is he's taken out the evaporation. we're going to lose 5%, so we're only going to get 95%. So that's in pounds. Okay. So we started with an 8,000 pound batch, and somebody already calculated really quickly for me. They said you're going to get 7,600 pounds. And what am I going to sell my decaf at? $12.50. Right? It's in the problem. Decaf Colombian, which can be sold for $12.50 per pound. So what do I get? $95,000. Right? Now, I could have sold it as regular Colombian coffee. Right? In that case, I'd still have the 8,000 pounds, but I wouldn't get as much for it. I'd get $10.80. Colombian coffee can be sold without further processing for $10.80. So what am I making extra? 8,600. So there's my differential revenue from further processing. Could have sold it as Colombian, but I've decided to sell it at decaf. I'm making an extra $8,600. I have to compare that to the differential cost of further processing. It's not enough just to make it. I know it's going to cost me more to do that. Right? It's a process. Get all the caffeine out of the beans. Don't know how they do it. And that costs $10,500. Oh, look at that. So, at the end of the day, the differential income of further processing is actually a loss of $1,900. Doesn't sound like a good idea. Maybe I shouldn't. So there's my differential analysis report. Next question. Should Seattle Roast sell Colombian coffee or process further and sell decaf Colombian? What do you think? Oh, they told me the additional processing cost would be $10,500 per batch. Okay, not enough just to make more. This is actually going to cost me more in order to do this. So what should they do? Sell decaf, sell regular Colombian? I think they should sell regular Colombian. Right? They're going to lose money if they process further. Okay, so sell it as regular coffee. Determine the price. This is interesting. Determine the price of decaf Colombian that would cause neither an advantage nor disadvantage for processing further and selling decaf. So I guess that's the point where we're indifferent. No advantage, no disadvantage of selling the decaf. So what do you think that means? No advantage or disadvantage. The point that we call this the point of indifference. I don't care. Let's do it. I don't care. It's not going to make a difference in my bottom line. If it's not going to make a difference in your net income, it would be zero. Exactly. So the differential revenue minus the differential cost would be zero. So if we do that same analysis all over again, there'd be no advantage or disadvantage. We'd be indifferent. We wouldn't be making money. We wouldn't be losing money if we processed further. So differential revenue less differential cost would have to equal zero. Okay, so we do know one of these numbers. The differential cost, $10,500. Right? They told us that in the problem. Therefore, the differential revenue would also have to be $10,500. So that means the revenue from decaf minus the revenue from the regular It would have to net out to 10,500. Well, I already know what my revenue from regular is, just working backwards. I have it on my last sheet, actually. It's 8,000 times 1080. It's 86,400. I think I can now solve for what's above. I'm just working backwards. So the revenue from decaf must be, I hope my calculator works this time. So if I solve for what this must be, I get 96,900. So let me just start from the beginning. They're asking me, what price would the decaf have to be that would cause neither an advantage or a disadvantage? Well, that would mean the end of my analysis would have to be 0. I don't care if I do, I don't care if I don't, because I'm not making any money, I'm not losing any money from doing this. So start to fill in the numbers. I know that it costs 10,500 to process into decaf. I'm just taking the numbers actually from the previous page. Right? Cost of further processing. Right? The cost of the revenue from the regular coffee, 86,400. Therefore, the revenue from the decaf, moving back, must be 96,900. They're actually not just asking me what revenue I should get from the decaf, but what should the price be of that decaf. Well, I can divide that by the number of pounds here. Right? So this is 7,600 pounds times something to get 96,900. There we go, 12.75. So the price of decaf would have to go up to $12.75 a pound for me to even consider this. Right now, the price of decaf is too low. I should not process further. But we know that commodity prices change. Coffee prices can go up tomorrow, as indeed they always do. So whenever it gets to $12.75, then I should consider processing it further. Until that time, don't make decaf. Right? Just work backwards. I think now is a time for a good time for a break. So I've got about 10 after 10, so we'll come back at 10:25. Right? Go enjoy a decaf Colombian or a regular Colombian coffee. All right, the lights are off, so that means I must be back on. All right, I hope that's the case. They're having some technical difficulty there. All right, so I'm just going to tie this back in, what we've covered, back into the See Now assignment that opened up yesterday. So the first problem here, can I ask you to bring your conversations to a close, please? Great. Is sell or process further, right? So you're given how much it costs per 100 board feet of processing rough cut lumber, which you can sell for $668. Or you can process further. So it looks like you get a rough cut or you can get a finished cut. And they tell you what you get for revenue under each one. Okay. So rough cut lumber sells for $668. Finished cut lumber, how much do you sell for? $886. Okay. But it's going to cost you. It's going to cost a total, and this is where I missed out on the first time I read it, a total processing cost of $594. Okay. So you're asked, what is the differential revenue? Okay, so what is the difference in revenue? Even I got that. I could subtract one number from the next. What is the differential cost? This is where I goofed on my first try. The total cost to get it to finish cut is $594, but the cost just to get your timbers is $514 here. Okay, so you have to look for the difference, right, between those two. So there's your differential cost. And I'll warn you again, this is algorithmic, so the numbers will change with every take. The amount of differential income, you subtract A from B. B from A, do whatever, get the difference and put it in there. So that's, again, very similar to what we've done just now about the decaf. So the differential income, the differential cost of processing further into decaf. So very similar. That's question 1. Question 2, I think we're Yeah, we're going to cover this in the second part here, the lecture, so we'll get to that later. Question 3, make or buy. Okay, so, remember how we structured that. What's the relevant cost to buy it versus the relevant cost to make it? And of course, it's a drop-down menu. This is going to be really nice. So this is your differential analysis report. We have seen one in the lecture. We did one in class. So generally, the first one that we put here is the price to buy, or the purchase price of the part. And then what are the relevant costs to make it? And it's up to you to identify which one of these drop-down items is a relevant cost to make. Okay? So go back to your slide. Differential cost to manufacture, the cost to make are generally all certain types of costs. Okay? It's either fixed or variable. So go in and identify which ones of these are relevant. Okay? And then at the end, of course, there would be either a cost savings or a cost to buying the part. Okay? So, and then put some numbers to it. Okay? Again, this one I believe is also algorithmic. So don't forget it will switch up with every try. Okay? And so I guess we still have one decision to cover so that you can do number 2. All right? So we'll get there. Slideshow. There we go. So this is where we ended. Accepting a business at a special price. All right, so this is, I hear a lot of talking. Is there a question on the See Now quiz? No? Is there a question with the See Now quiz? No? Okay. All right, there's just so much talking, and I know that other people are actually trying to hear the hints that I give about the See Now quiz. All right, so accepting a business at a special price. Yes, we sometimes get asked, just to lower our price a little bit, okay? Or a lot of things are negotiated, too, in business, okay? So we say, okay, the price is this, but for you, I'll cut you a special deal, because some people might say, well, I'll take my business elsewhere. So you might say, well, I can reduce my price. And this will help us do the appropriate analysis to determine just how low we can lower our price before we say, well, forget it, go somewhere else. So we've got a basketball company now. So they produce an average of 10,000 basketballs, although the factory has a capacity of 12,500 basketballs. So we're given the variable cost to make the ball, $12.50. Fixed costs are $7.50 per ball. They normally sell it at $30 a ball. However, they get this special offer in. The company receives an offer for 5,000 additional basketballs, and they're only offered 18. And you think, you know what? That's way too low. Look at what we normally sell the basketball at. We normally sell it at 30. Should we just say go away? Because just looking at our costs here, well, variable costs and fixed costs, if I put those together, well, that's at least $20 a ball. Why would I accept 18? Right? So again, we have to focus on what's relevant here. What will change up, okay, by accepting this special offer? Okay? What are my variable costs, my relevant costs to actually make the ball? Right? So let's take a look. What revenues will change if they accept the order? What costs will change? Well, I know I'm going to get some extra revenue. That I know for sure. My extra revenue, $18. Okay? So that's what's switching up there. And how many did I hope to sell? 5,000. So just focus in on the difference. Okay, that is the definition of relevant revenue and relevant cost. So we're going to get an extra $90,000, but what costs will change? Okay, what are the relevant costs? So let's go through. Are variable costs relevant? Will I incur them if I accept this special order? Yes, by definition. Very good. $12.50. Okay, so let's put $12.50. Now the other cost information we're given, fixed costs are $7.50. Will I incur that if I accept this special order, $7.50 a ball? You're still going to incur it. That's the definition of fixed, right? So fixed costs actually will not go up. And remember what fixed costs are. Here we go again. So fixed costs, what might be included in here? rent, insurance. I'm going to go back to those two. I don't know. So my total fixed costs, let's say, are $35,000. This goes back to a previous page I had set up. And yes, I can divide by the number of balls here to get $7.50 a ball. Okay, that's what somebody has done. In order to calculate the fixed cost per ball of $7.50, they've taken all the fixed costs, divided by some allocation base, probably the number of balls, and said, okay, it's $7.50 a ball. But think about it. If you accept the special order, will your rent costs go up? No. Will your insurance premium go up? Nope. Okay. So will you incur the fixed cost of $7.50 per ball if you accept the special order? Nope. Will not. So my only extra costs then are the variable costs, $62,500. I think I'm going to make some money here. Right? It all looks good. And we do make money. We shall have differential income from accepting the offer, $27,500. Alex? Yeah, yeah. And so that's the thing to ask yourself here. Do they have the excess capacity here? So, actually, yeah, I think I made an error. Let's say they do have capacity. I don't want to confuse that. So let's say they do have enough capacity to accept the special offer. Because in this course, I will not add capacity issues anyway. So yes, let's just say that they do. Okay. So yeah, so let's just assume that they do have excess capacity and they can produce the additional product without incurring additional fixed costs. Okay. So whether differential revenue covers relevant costs and produces income is the issue. Right? In another course, I would actually go talk about capacity in much detail than this, much more detail. Right. So, this is the critical question. Why don't they sell all of their basketballs at $18 a ball? They're making money. Yeah. They won't cover all of their fixed costs. Okay? And they still have to do that at the end of the day, okay, in order to make money. So it's not bad to accept a special order, you know, for a little bit of your excess capacity. Okay, we've got 5,000 balls we could be making. Yeah, let's accept $18 a ball because we will cover our variable costs and then some. We'll contribute partly to fixed costs. But if we sold them all at $18 a ball, we wouldn't cover all of the fixed costs. We'd lose money. And that's not what we try to do in business. Okay. What other factors should they consider besides the dollars? Sort of non-financial things. That's pretty good. Let's say you're the manager here. You've been asked to consider the special order. You do the numbers. You say, yeah, looks good. I'm going to accept the special price. I'll do that. But what other things should you consider? All sounds good, though. Yes, can you fill the order? Certainly. Yeah. Maybe there's a deadline. What if one of your regular customers finds out about this? You know, customers talk, and they might say, hey, you know, that company, they'll sell you basketballs at $18 a ball. But you're a regular customer, and you normally pay $30 a ball. You don't want it to affect your regular customers at all. Right? So if you're going to do something like this, tend to do it with, you know, in a different geographic location. Okay? No, not necessarily. No, you're covering your variable costs, and you still have some money to cover some of your fixed costs in total. So you're covering your variable costs of $12.50. Fantastic. You've got a little bit extra now to cover your fixed costs, to pay for the rent and the insurance. We identified the only two fixed costs. All right. Yeah, you don't want to do it as a normal course of business, so do not sell everything at $18 a ball. Okay, and be concerned about, you know, having to make these concessions on future orders. okay, because you cannot do it. It's not the way to make money in the long term. All right, so we've got one exercise from the book. Roadworthy Tire and Rubber Company has the capacity to sell 170,000 tires. Roadworthy presently produces and sells 130,000 tires. And you'll notice throughout this entire chapter, there's always enough capacity for the special order. Okay? So what do we have here? There's excess capacity of 40,000? So we could be making an extra 40,000 tires. We normally sell at the market price of $90 per tire. Roadworthy is evaluating a special order from a European automobile company. So they're getting out of that geographic location. They don't want to be letting on to their North American customers that, we might contemplate a special order. Euro Motors is offering to buy 25,000 tires for $75 per tire. Roadworthy's accounting system indicates that the total cost per tire is as follows. Direct material, direct labor, factory overhead, selling and administrative expenses, and then there's the total 85. Okay, so if it cost me $85 to make it, why would I consider, where's the price? $75. Sounds pretty foolish, right? Okay, but let's actually take a look at that. What are they asking me to do? Roadworthy pays a selling commission equal to 5% of the selling price on North American orders, which is included in the variable portion of the selling and admin costs. Okay, so then included in here is a 5% commission. That's what they're saying. However, this special order would not have a sales commission. I guess we have to consider that as well. If the order was accepted, the tires would be shipped overseas for an additional shipping cost of $6 per tire. That's definitely going to be something to take into consideration because that would be relevant. Okay. In addition, Euro has made the order conditional on receiving European safety certification. Roadworthy estimates that this certification would cost $125,000. Wow, that is steep. What do we do? Oh, it's not here. Okay, well, I guess the question is probably, should they accept the special order? Okay, so we'll do an analysis similar to, there we go. It'll look like this: differential revenue from accepting the offer. No. 12, 13. The other part of this format, differential cost. Okay, we'll get some differential income at the end of the day. Okay. So, just identify what extra revenue will they get in. Well, it is 25,000 tires at $75 each. So Euro is offering to buy 25,000 tires for $75 each. Now, what extra costs will we incur? That's the question. Will we incur direct materials? Yeah. Right. Is that 32? What about direct labor? Will we incur that if we accept the order? Is it relevant? What do you think? Of course, yes. Yeah. All of our variable costs for certain, okay, go in here. Direct materials, direct labor. Now, factory overhead. They've said that 60% of this is variable. We know that by definition, variable costs are relevant. 15. Oh, I don't need my calculator anymore. I got Alex up there. All right. And 35. How much? 6? I got 7. All right. Oh. All right. 35% of 20 does equal 7, but then he's saying 5% of that is commission and is no longer relevant because they're not going to incur it. So, but it's 5% of the selling price, right? And the selling price is normally 90. So we'll take, so that means on every tire, what do they have to give up? $4.50? So they're saying that the $4.50 is included in there, and that we're not going to incur any more. Well, now I'm getting $2.50. Right? Okay. So factory overhead, the variable portion is 15. It's certainly variable factory overhead. And variable selling and admin. So I get 35% of the variable is $7, but I will not be incurring the commission anymore, the 5% on the selling price. So that will leave me $2.50. Anything else that's relevant in accepting this order? Another relevant cost. Ah, right, good, Jason. Shipping. Because they have to send them overseas. There's an additional $6 per tire. And as well, there's a certification. It's just a flat fee, $125,000. So these are all, we'll subtotal that, because they're all per tire. So I get $63.50. And then when I multiply by 25,000 tires, 1,587,500. But I also have another relevant cost, and that's the cost of the certification, 125,000. So I'm going to continue this on another page. Just keep that there. Certification. 125. So my total costs, $1,712,500. Is it worth it? Well, we're going to get extra revenue of $1,875,000. So I'm still making money, $162,500. Okay, differential income. So I should accept it. Okay, might want to consider, that I don't want my regular customers to know about this, but it's in a separate geographic location, so I'm probably okay. Okay. Any questions on this problem? Okay. Let's just go quickly to the See Now quiz. All right, so here's a problem. The second problem in the See Now quiz that's due next week has got to do with accepting business at a special price. They operate at 85% capacity during April. They make 28,050 batteries, and this is their total cost for the 28,050 batteries that they're budgeting for. But they have this opportunity to submit a bid for 2,000 batteries to be delivered by April 30th to a government agency. And what often happens with governments is they ask for bids. They purchase things through a bidding process. And so they want to submit a bid. So if the contract is obtained, is it anticipated that the additional activity will not interfere with normal production during April or increase the selling or admin costs? What is the unit cost below which PowerServe companies should not go in bidding on the government contract? Okay. So it's not actually asking you to set up the problem like we just did. It's more, what is the minimum price? So that you don't lose any money. So really what they're saying is your differential income is 0 and work backwards. Okay? So you could work backwards, but at the end of the day, what do you want to do when selling these batteries? What costs do you want to cover? Your fixed or your variable costs? Variable, right. Those are the only relevant costs. So whatever price you determine, there. It's not writing the way I am writing. Let's try that again. Minimum price. Okay. Must equal total variable costs. But they're asking for the unit cost. So figure out what your unit cost is. So you to take your total variable cost, divide by the number of batteries you're budgeting for. Okay. So go through those list of costs, identify which ones are variable, divide by the number of batteries, which in this case, this is algorithmic, which will switch up every time. In this case, it is 28,050. And that's going to be your minimum cost that you'd like to not go below. Okay. Right. The other option, of course, is just working backwards. You want your differential income here to be 0. Okay. So figure out what your differential costs are, and so have enough revenue to cover that. Any questions on any of the CNOW problems? Okay, so last topic, setting normal product selling prices. Right. There are numbers of different ways of coming up with a price. Okay, so most often, I'm going to tell you, it's dictated by the market. So you're making pizza, let's say, and you want to know what price should you sell your pizza at. Well, the market's going to tell you that. Because a lot of products, we're in a competitive environment. There's going to be more than one supplier, and you're not going to have the luxury of actually setting the price. So what you're going to do is you say, okay, I'm going to make a pizza for $20 for the extra large pizza. Therefore, I'm going to have to make sure that I don't put that much cost into it, that I'm covering my costs and enough profit. And they just call that target pricing, okay? Or target costing, actually, because what you do is you figure out what the market price is, figure out what profit you'd like to have, and then it leaves you with what your target cost should be. And that's by and large how prices are set. How much can the market bear? All right? Every so often, especially whenever you're selling a new product, you have the luxury of setting the price yourself. Okay? And so you're going to want to make sure you cover all of your expenses, provide for a little reasonable profit. Okay? And we call that cost plus methods. And I'm just going to cover one. I know this textbook does cover way more than that, but I'm just going to cover one cost plus method. Okay? So you want to cover your costs and something called a markup, your profit. Right? And that will be your selling price. So, as I mentioned, I am only going to cover total cost concept. We'll add a markup to all of the costs, including, of course, selling and admin. Okay? I'm not going to cover these other two. Product cost concept, variable cost concept. So let's consider these costs. We've got total variable costs here of $16 a unit, and some fixed costs, some factory overhead, some selling and admin. Okay? How should I set my price? Well, in this case, markup will be added to all of the costs, including the selling and admin, including the fixed costs. Okay? So I want to make sure I cover all my variable costs. In the last slide, that was $16. Okay? I want to cover direct material, direct labor, overhead, selling and admin, and I also want to cover my fixed costs. How am I going to do that? I total it up, and I divide by the number of units. So in this case, 70 cents per unit. So I need this to cover at least $16.70. Okay, so the price is going to be at least that. Okay. But I want a certain profit. Okay? And oftentimes, profit is expressed as a percentage of assets. It's like a return on investment. Okay? I've invested so much in this business, or it's got assets of so much, I want the return to be 20% of it. So at the end of the day, for this company, they want profit of 20% of their total assets of 800,000. This is what they'd like the profit to be. And what they'll do is they'll just divide that up by the number of units. Okay? So 100,000 units, that means I want my profit to be $1.60 per unit. And then I add that to my selling price to get to my selling price. So one last concept here to cover off. What would be the markup then in this case? Okay. The markup being, how much am I going to multiply the cost by in order to figure out my price? That's the desired profit divided by the total cost. I want to have a profit of $1.60 per unit. The total cost is $16.70. Therefore, my markup is going to be 9.6% of that cost. Okay. So if I wanted to come up with the total price, it's always as a function of the total cost, multiply in this case by 1.096%. Bring it up. Okay. And there's the proof there at the bottom. If I sell everything at $18.30 a unit, my sales will be $1,830,000. There are my costs. I've detailed these out already. And lo and behold, I am making $160,000 there. All right. So just a quick exercise here for setting a selling price, which I hope to finish before 11 o'clock. So you can have your 2 minutes of silence. My phone uses the total cost concept of applying the cost plus approach to product pricing. The cost of producing and selling 5,000 units of cell phones are as follows. So we're given variable costs. Okay, they're obviously going to want to have that as a component price and the fixed costs. What do we have there in total? 215, 75, 290,000. So they want to cover at least that and allow for some profit. So what I'm going to do with the fixed costs is I have to express it, remember, on a per unit basis. And we sell 5,000 phones. 58, thank you. So there's my total cost. This is the total cost approach. That's my first step. But I also want to add up the markup. Okay? And that's where we see that they want a profit equal to 25% of invested assets. What is that, Alex? It's 100,000. I thought you were like 5 steps ahead of me. All right, so they would like to have profit of 100,000. And again, this is another one of those numbers we divide by the number of phones. Okay? So that's $20. So in total, they would like to sell it, I guess it's $318. Okay. Any questions on setting prices? It's very quick. No. There's no See Now quiz on the question on this sort of thing. No questions? All right. Well, oh, there we go. Determine the amount of profit. We did that. Total cost, cost markup percentage. Determine the selling price. There, we've done it. And that is the end of chapter 12. We're really moving along. So ended just in time for your 2 minutes of remembrance. Have a good week.